Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. Let's start with DBS Group Holdings, Singapore's banking giant that's been making headlines lately. DBS has raised CEO Piyush Gupta's total remuneration for 2024 by a whopping 56%, citing record profits, standout performance in their wealth business, and strengthened technology infrastructure. This substantial pay increase reflects the bank's strong performance throughout 2024, where we saw DBS shares surge by an impressive 44% last year. The banking sector as a whole was a standout performer in Singapore's market last year, with financial stocks collectively rising by 34%. DBS led this charge, helping push the broader Singapore market to a 17-year high, with overall gains of 16.9% in 2024. Currently, DBS is trading around the $42 mark, continuing to show strength in early 2025. What's particularly interesting about DBS is how it's navigating the changing interest rate environment. With the U.S. Federal Reserve expected to implement multiple rate cuts in 2025, possibly 4 cuts according to some analysts, which is double what's currently being guided, banks like DBS will need to adjust their strategies. While lower rates might squeeze interest margins, DBS's diversified revenue streams, particularly its wealth management division, position it well to weather these changes. Moving on to Mandarin Oriental International, the luxury hotelier has posted mixed results for the 2024 financial year. The company reported an underlying profit of $74.7 million, which represents a decline of $81 million from the previous year, translating to a full-year underlying loss of 8%. The group attributed this downturn to lower one-off residences branding fees, which overshadowed the strong growth in recurring hotel management fee income. Loss per share came in at $0.0622, compared with $0.2891 the year before. Despite these challenges, Mandarin Oriental maintained its dividend at $0.05 per share, signaling confidence in its long-term outlook. The counter closed flat at $182 on Wednesday before these financial results were announced. The luxury hotel sector continues to face headwinds in certain markets, particularly with ongoing economic uncertainties in China affecting tourism and business travel across Asia. Now let's talk about SATS, Singapore's premier ground handler and food solutions provider. SATS has announced plans to invest $100 million over the next 2 years to upgrade terminals in the Changi Air Freight Center. This significant investment is part of broader plans to enhance Singapore's position as a leading air cargo hub, as highlighted by Transport Minister Chee Hong Tat during his ministry's Committee of Supply debate on Wednesday. It's worth noting that this investment is separate from the recently announced $5 billion top-up for the Changi Airport Development Fund in Budget 2025. The planned upgrades are expected to boost cargo handling capacity by an impressive 30%, bringing the total to 3 million tons annually. This positions SATS to capitalize on the growing air freight market as global supply chains continue to evolve. SATS shares closed on Wednesday at 307, down slightly by 0.3% or 0.01 bars. The company was among the transport-related stocks that performed well in 2024, benefiting from unexpectedly aggressive interest rate cuts. With air travel continuing its post-pandemic recovery and cargo volumes growing, SATS appears well-positioned for 2025 and beyond. Let's shift our focus to Singtel, one of Singapore's blue-chip telecommunications companies that's been hitting new highs recently. Singtel shares have performed remarkably well, surging by 45% over the past year and gaining nearly 10% year-to-date, recently hitting their 52-week high. This impressive performance comes on the back of solid financial results, with underlying operating profit increasing by almost 13% year-on-year to $1.1 billion and underlying net profit improving by 11.3% year-on-year to $187 billion. What's driving this growth? Singtel's regional associates saw their combined net profit rise 4% year-on-year for the first 9 months of FY 2025, with particularly strong contributions from operations in Indonesia and Thailand. The company has also been making significant progress on its ST28 strategy, becoming the first in Singapore to deploy the 700mm spectrum, which has boosted its 5G coverage capabilities. On the dividend front, Singtel's management has provided guidance for a total ordinary dividend of around 165 for FY 2025, which includes both core dividends and value realization dividends. If realized, this would represent an increase from FY 2024's total dividend of $0.15, making it an attractive option for income-focused investors. Now let's look at the broader market trends and what we might expect for the rest of 2025. After the stellar performance in 2024 that saw the Singapore market soar by 16.9% and hit a 17-year high, 2025 is shaping up to be a year of both uncertainty and opportunity. The Straits Times Index, STI, has increased by about 108 points, or 2.85%, since the beginning of 2025, showing continued momentum despite global economic uncertainties. However, it's not all smooth sailing. The market recently reached an all-time high of 3951.64 in February 2025, but analysts are projecting some moderation, with expectations that the STI will trade at around 3812.63 points by the end of this quarter, and potentially drop to 3685.78 in 12 months' time. This suggests we might see some consolidation or even correction in the coming months. One sector that's worth watching closely is REITs. After underperforming in 2024 with a decline of 11.8%, weighed down by exposure to Chinese properties, REITs could be poised for a comeback in 2025. With interest rate cuts on the horizon, declining financing costs should alleviate pressure on dividend payout growth, potentially making REITs more attractive again. Speaking of interest rates, this remains a key theme for 2025. Phillip Capital predicts 4 U.S. Federal Reserve rate cuts this year, double the 2 currently guided. This more aggressive rate-cutting cycle could have significant implications for various sectors of the Singapore market, particularly rate-sensitive ones like REITs and banks. Another area showing promise is the digital sector. We've seen interesting developments with companies like iFast expanding into digital banking and digital core REIT, making steady gains in the booming data center industry. These trends highlight the ongoing digital transformation across various industries and the opportunities this creates for investors. It's also worth noting that the Singapore stock market has been facing some structural challenges. There have been concerns about poor valuations, evaporating liquidity, and a lack of new listings, creating what some describe as a vicious cycle. However, SGX CEO Loh Boon Chye has maintained a positive outlook, stating that the exchange has a healthy pipeline of IPOs, including secondary listings and simultaneous dual listings. To wrap up today's market digest, let's remember that despite short-term fluctuations, investing is a long-term game. As Paul Chu, head of research at Phillip Capital, noted, despite the recent rally, long-term returns over 17 years have averaged 4.5% per annum, including dividends. The market has essentially treaded water since its all-time high in 2007, he remarked. This perspective helps us maintain a balanced view amid daily market movements. The Singapore market in 2025 presents both challenges and opportunities. While global economic uncertainties, particularly around U.S. policies under the Trump administration, create headwinds, sectors like financial services, telecommunications, and digital infrastructure continue to show promise. The anticipated interest rate cuts could also provide a boost to certain segments of the market, particularly REITs and other yield-sensitive investments. As always, I recommend staying patient, disciplined, and informed in your investment approach. Diversification remains key in navigating the uncertainties of 2025, and focusing on companies with strong fundamentals and clear growth strategies will serve investors well in the long run. That's all for today's Singapore Market Digest. If you found this analysis helpful, please hit that like button, subscribe to our channel for more updates, and share your thoughts in the comments below. I'm Iggy from the Investing Iguana, and I'll see you in the next episode. Happy investing!